Warren Buffett's investment advice you should follow. Warren Buffett's Berkshire Hathaway company has made tens of billions of dollars. Buffett is a witty investor who loves to share his common sense counsel. His advice covers financial, non-financial, and life difficulties. Let's focus on Buffett's wealth-building advice for now. Amazingly, Buffett's simple counsel can provide a significant financial reward. So without further delay, let's start our video. The first rule is that you must never lose money. Never forget rule number 1. That's rule number 2. Here, Buffett's statement comes off as elementary, but it's actually quite subtle and nuanced. Although making a profit in the market is the ultimate goal of any investor, limiting losses is one of the most effective strategies. It is more likely that you will make a profit when you reduce the number of portfolio-threatening decisions you have to make. You can accelerate the compounding of your gains by increasing your portfolio size. The way you invest may need to change if you adopt this strategy. Following Buffett's advice, one should prioritize minimizing risk before considering the potential reward. That's an alternative perspective to those who treat the stock market like a gambling machine. Chances are rare. Don't be stingy with your riches. Use a bucket, not a thimble, when it rains. Here, Buffett advises readers to act promptly and forcefully when they spot an opportunity. It's important to make large investments at times when the chances are in your favor, such as when stock prices are down dramatically, because you may not get another chance at such low costs anytime soon. Buffett frequently employs this strategy in times of severe market decline. He saves up a lot of money during the up times so that he may make some bold moves when the market crashes. He is able to employ this tactic since he has a sizable amount of liquid assets. We try to be scared when other people are greedy, and greedy only when others are fearful. Buffett argues that the human element is key to successful investing, countering the view of others who believe it is all about the numbers. Buffett is concerned that a market crash is imminent whenever greedy investors drive stock prices to new heights. On the other hand, Buffett is more interested in the market or a particular stock when investors flee from it or the store because of falling prices. Stocks pose less of a threat when they're reasonably priced. That's also how Buffett tries to keep his investment from going south. Concerns about the pandemic's potential spread caused the market to tank at the beginning of 2020. A few brave souls, however, entered the market despite the widespread panic, and the price of stocks shot up sharply from their lows. Buying a great firm at a reasonable price is preferable to buying a good company for a high price. Buffett advises value investors to buy excellent companies with better economic and competitive positions rather than cheap equities. Excellent firms rarely offer discounts, but fair ones do. If you overpay, a company with a lasting competitive edge will save you. Honest company may fail and never repay you. Buffett has also invested in Bank of America, a national bank with a strong deposit franchise and a large branch network. In the second quarter of 2022, Berkshire Hathaway's second largest holding was valued at over $32 billion. A good investor's temperament matters more than intelligence. It would help if you had someone who doesn't enjoy following the crowd. Buffett again emphasizes character over intelligence for investment success. Instead, than predicting stock prices based on others' opinions, investors should assess the market as a whole. Hard data can help investors make reasonable, less emotional decisions. If you're enjoying this video, please hit the like button and subscribe to our channel if you haven't yet to show your support. Now let's continue. The stock market is a so-called strike game. You can sit back and wait for the perfect pitch instead of swinging at everything that comes your way. One of Buffett's most famous quotes captures the core of opportunity selection. You shouldn't put money into an opportunity unless you've determined that the potential benefits outweigh the risks. Once again, Buffett advises waiting to invest until an opportunity presents itself that it is unlikely to result in a loss. Avoid taking any chances on stocks that don't interest you. If you enjoy investing that much, go ahead and put in 6 to 8 hours a week. Don't do that, else invest in index funds on a dollar-for-dollar basis. For a long time now, Buffett has advocated that most investors use index funds rather than trying to pick individual stocks. If you try to beat the pros at picking stocks by yourself, using only limited information, you'll be sorely disappointed. Contrarily, if you invest in an index fund pegged to the Standard & Poor's 500 indexes, you will effectively control the market and have a leg up on everyone else. Investing is a hobby for some people, and that's great. If you're one of them, go for it. But most people would be better off using an index fund, especially not trading in and out of equities. Using index funds also provides instant diversification, reducing your risk. The adage goes, you don't get paid for activity, you only get paid for being correct. You can always find an expert or pundit on the stock market who will tell you exactly what you should do with your money. Buffett emphasizes here that investors would be wise to avoid the temptation to engage in active trading, which entails rapidly moving from one investment to another. In investing, staying busy can give you a sense of accomplishment, but success ultimately depends on the accuracy of your research. After all, the tide goes out, and you'll know who was swimming naked the whole time. In some ways, investing may seem like a walk in the park. Long-term bull markets are possible, and so can ferociously rally. However, according to Buffett, when time's rough, you find out who's fortified and ready to weather the storm. In his long history of investing, Buffett has occasionally seemed to be moving in the other direction of the herd. However, circumstances always change, and it eventually becomes clear that those who were intelligent before were actually just swimming around without their trunks. Your investment portfolio should always be prepared to weather a downturn. Well, that's all for today's video. Tell us in the comments section how this one was. I hope that you found this video interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.